Our next panel is called Bringing Unsexy Back, focused on middleware. At Unbank.Ventures, we're all about FinTech founders that are creating software solutions for banks and financial services. Today, we wanted to highlight the unsung heroes of FinTech that create collaborative products and services that are pushing the industry forward, in spite of the last panel that ended with bloodbath. I'm very excited to have our moderator, Jennifer Anderson. She came highly recommended through our advisor network. Currently, Jennifer serves as the Vice President and Head of Product at Let's Talk Payments, and she has led product development at Lending Club. Without further ado, I'd like to hand it over to Jennifer and the panel.
Thank you. I guess Ian, we're missing Ian.
I think Ian's missing in there.
Oh, okay. The weather, the rain. Yeah, so I'm Jen Anderson. He already gave my brief bio and intro. Actually, we're renamed Medici. So we've been around about 4 years, started out as a newsletter, and now we're building a community for FinTech professionals worldwide. No relation to the prior moderator, Ryan Anderson. And so they were getting really into the meat of it towards the end of their conversation, so I'm actually going to do quick intros. We'll have 20 seconds of intros, and then ask some of our meatier questions first to hope to continue a lot of that conversation.
So my name is Sam Harrison. I work at Knock Knock Labs. I run the strategic partnership program there and strategic programs. And we do, effectively, it's authentication technology. So removing username and passwords from your experience, but making sure that we have the strong assurance of identity passed through to the relying parties.
Good afternoon. No, still morning. My name is Will Mitchell. I'm the founder and CEO of Contract Simply. We help builders and developers manage their construction loans with banks.
I'm Laura Spiekerman. I'm a co-founder and chief revenue officer at Alloy, which is an API and workflow management tool for regulated financial institutions to manage their KYC, their Know Your Customer and anti-money laundering requirements.
Great. So I'm going to start with questions, but if anybody has anything they want to ask our esteemed panelists, feel free to jump in and raise your hand, and we can definitely ask some questions. One of the first things I wanted to know, you all are, I would say, technology enablers, right? You're building that unsexy middleware that is really helping the banks, the financial institutions, the larger companies, be able to innovate and be able to grow their businesses in very different ways. So one of my first questions is, the hardest part is you're selling into these large companies, getting off the ground, getting going. How did you get your first partner, your first customer? How was that process?
So Knock Knock Labs has been in business for several years, about 4 years, 5 years. We just closed our Series D earlier this summer. Our first customer was actually PayPal. Now you have to go back to kind of the origin of where Knock Knock Labs came from. It was founded by this man named Ramesh and Michael Barrett, who at the time was the CISO of PayPal. So when Michael and Ramesh came together, they actually also founded an industry alliance called the FIDO Alliance with Knock Knock and PayPal and Lenovo and a few other players. And so it was pretty straightforward to say, oh, this is really cool, let's go invent that, and then let's put it in PayPal. And then Alipay and a few others. So it just came from the genesis of what was needed in the industry.
So we're a little different story. We just started in February, and we're still kind of onboarding our first few customers and getting that real reference customer base built up. One of the things we did was, going outside of traditional banks and talking to alternative lenders, such as hard money lenders, which are active in our space that can be case studies for what we're doing, as well as just working directly with the builder and developer without bringing the bank on board initially has been a successful strategy for us to onboard a part of the solution for a part of the ecosystem without trying to get too deep with the bank to start with.
I think the way we got our first customer was at the time we thought was a one-off, which was that we were sort of scoping out whether or not, frankly, we even had a product that the market wanted, and we were just talking to a bunch of different people who were building digital banks, neobanks, new products within banks, and so eventually it resonated with one particular neobank, and they were our first customer, and they enabled us to build what we were building, and we got a lot of feedback along the way, and it was fantastic. But what's turned out to be, what we thought was a one-off and sort of the way we got our first reference customer ended up being sort of the way that we work with the market today, which is we go to people, and that can be people building new fintech companies, people building neobanks, or people within a very, very large financial institution launching a new product at the moment where they're sort of starting to build, looking at APIs, looking at new software solutions, rather than, and they're definitely trying to get away from their legacy systems when they're doing this, and so that became like a really good selling moment for us.
So the last panel, they talked a lot about how regulation is forcing a lot of the cooperation and partnerships between the fintechs and the larger banks and FIs. How do you guys feel about that? Do you feel like it's a ripe time to be in the space you're in and that this is a great opportunity because everybody's looking for the latest and greatest and the coolest technology?
Yeah, I can jump on that one. For us, it's been amazingly helpful. There was legislation passed that expanded construction lending for credit unions last January. Basel III, HVCRE are big concerns that, frankly, a lot of the banks don't even understand, potentially because they're not well defined. And as a result, looking for solutions to help them track this. We're speaking at a regulation technology conference at the end of the month because it is such a big concern. And so they're looking for things to help them in this regard.
Yeah, I think we're a compliance company, so the only answer for me really is yes. But I think that's true broadly. Like we're seeing, banks need to move quickly. They need to be able to adjust to the regulatory environment quickly, easily. The availability of digital data is just much greater, so they're sort of looking like, how do I get this fast? It's not going to be an internal build. I mean, they might think it is, but it's not going to be. So I think
That's actually a really interesting point. It's the idea. This goes back to the concept of a buy versus build. When we talk about PSD2, GDPR, when we talk about NIST recommendations or various different things happening in the regulatory space here in the United States, banks, fintech companies, large companies, anybody who deals with customer data, they're going to have to address these requirements, and one way is to build it themselves. The other way is to go find someone who's already done it and is keeping it up to date and already knows how they solve this regulatory compliance issue and buy it from them. So going back to how you get your first customer and how you grow your business, the regulatory aspect is a great driver to say, look, we can bring you to market in 2 months rather than you needing to evaluate it, build something, and deploy it a year later.
Great. Welcome, Ian. Do you want to do a quick intro?
Hello, hi. Yes, still entrepreneur, 4 times doing startups. This is one around helping banks find new business customers. Great.
Yeah, and so what's interesting about your company is you have a solution that's actually going to lead immediately to revenue, right? It's a path to revenue for these larger companies. So talk about how you got your first customer, how you won them over.
Yeah, so we've had a lot of pain in my other companies about trying to bring down large companies and acquire them. So we took a completely different strategy this time. So our thinking was, let's start off small. So our customers are banks. So it could be someone like Chase Bank, who has a large group of business bankers. So what we decided to do is, rather than go through the long RFP process, instead we went to a collection of bankers who we knew personally and said, hey, try out our data, tell us how it works for free. And then they used it, and then we build out from them. So why don't we have a team meeting and share with what the success from the team meeting was with your regional manager, then from the regional manager, then the other regional managers. And then we sort of built up rather than go in the RFP. And about halfway through, after we'd gone to a couple of regional managers, suddenly someone from the central team said, hey, I hear you're doing some interesting stuff. And I said, yes, and here's your data to prove how effective we are. Now, let's do a national deal.
Okay, so just digging a little bit deeper, it sounds you guys are painting pretty rosy pictures, and I worked at a bank or two in my day, so I know how hard it is to onboard startups. What was that process like? I mean, how long did it take? Was it painful? What suggestions do you give for the startups out there in the crowd just starting out, and even the bankers out there on what could go better?
Sure. So yes, the answer is it is very painful. many of the banks that we're working with right now are like, well, I'm putting this in my RFP planning process for 2018, which just those words break my heart to hear. And so, what I've found in our experience is that right now the banks don't just have one technology initiative, they have 1,000 technology initiatives. And the biggest kind of blocker in that process is the IT department's ability to vet you as a vendor. And so there's been some new initiatives. Actually, I saw something in American Banker yesterday about some collaboration over vendor management that hopefully will help banks be better enabled to absorb new vendors. But the process, unless you are able to immediately show value and not touch any core systems, which perhaps Ian is, that it's hard to kind of prioritize yourself in front of that 1,000 different initiatives unless they've got some pretty impressive vendor management processes.
Yeah, no, it's a beast, especially for startups who are looking for revenue quickly. The RFP process dramatically lengthens your sales cycle. It really, really hurts. So from my perspective, the first thing that a startup can do is, if you're going to engage in RFPs, start tracking your answers to these RFPs, because you're going to use them over and over and over again. You'll want to customize them, but you'll want to have some common language about, what's your value proposition, what's your backing, what's your financing, how you're capitalized, all of these very standard questions. The other aspect that has actually been very successful for Knock Knock is, forget about the banks themselves, go for their systems integrators. Go for the people who are bundling these technologies and selling them into the banks.
Cores.
Yeah, and that ends up being more helpful, because if you can get in with an SI that's already in the bank and you're just offering a new feature on top, then you don't have to deal with the RFP process, which is nightmares.
I think the other thing that, I agree with everything that's been said. The other thing that helped us more tactically was getting our SOC 2 done really early, which just meant that we, sort of similarly to having everything in your RFP written out so you can copy and paste it for the next 5 RFPs, getting your SOC 2 done means like it's not a fun process, but once you've done it, and you have sort of everything you need around business continuity and data storage and all that stuff that is super important to a bank done and ready to go, and you can sort of show them your report. That's been really key for us in getting a couple of our bank clients up and live.
Have you had to do any of that, Ian, or are you not integrated into?
In previous companies, the reason why I chose this path this time around. So on previous times, we had a really hard time. And so what the approach we took there is try and find try and work cause as touch. Everyone tries that. It's a great approach. But they often say, I want to see a deployment before I bother with you. So the way to do that is go and find a community bank and then work with them, have a case study. Case studies are great. If you have case studies, have video testimonials, all that sort of stuff is, and then find a champion. Find someone who really likes you. Meet someone at the conference like this who works the bank. If someone's here and not in their day job doing the front bank, it shows you they are interested in technology. So hang out with those people, find them as champions, and then use them to be advocates for you inside the bank.
I think there's also there's 50 or 100 banks in the United States that are in the middle of this kind of digital transformation, small, including very small banks where you would never know their names, but they somehow are working with fintech companies, building a lot of new technologies, and their names are out there. I think those are the ones, at least for us, that we see as being really good early targets who are more likely to adopt us and are not. They're not thinking about building this internally. They only buy.
And there's some in the Bay Area. I mean, there's the Technology Credit Union down in San Jose. They're quite progressive guys. They just don't jump on planes. There's enough here.
Cool. And then what about on the other side? So the community banks you mentioned, oddly are a bit friendlier toward this process. And in terms of the larger players, are they getting better at onboarding? I mean, now that FinTech is, beyond its infancy, and how's the process getting? I mean, I'm going back to 2010, and last time I tried to onboard a startup at a bank, and it wasn't pretty. So,
so for Knock Knock Labs, it's not pretty. In fact, there's a secret about getting onboarded or innovation at financial institutions, which is they actually don't innovate. You get stuck in the mud really easily. a lot of fintech startups will die in the POC and pilot universe, where they're constantly being POC'd and they're constantly being piloted. So, the number one recommendation is find that champion outside of the innovation lab that says, okay, we got to push this out because the ROI is so strong. It's a difficult process, and part of the other thing is the fact that a lot of the fintech stuff, anytime you touch a customer, you're going to end up going across so many different departments inside a huge bank that you're going to have to win that fight and win those battles over and over and over again.
So I'll be a little bit more optimistic about it. We're working with a number of the, top 10, top 20 banks in the U.S. And frankly, many of them have venture arms at this point. They have innovation arms. Potentially, I'm disillusioned still because it's early, that I'm not going to be in, this, pilot purgatory forever. But
Pilot purgatory. I'm going to steal that later.
It's copyrighted. But they at least have, what we're seeing is the banks are really interested in the customer experience, and they're seeing the threats of, SoFi and Square at their door disrupting their business. And so at least on a macro level, they're excited about the opportunity to improve their customer experience, which is what we're providing, which is making them interested in having conversations. Whether or not they're able to really bring it in-house and implement it across the organization, we're still early, but I remain optimistic.
One thing I'd say is spend some time building out what's called I'm sure everyone knows it, the buyer persona. So there's typically, Gartner says, about 4 to 5 and even 6 now decision makers inside the organization who are going to choose to bring you on board. And you need to have really, if you're going after whatever type of company you're going after, really clear understanding who that buyer persona is. What do they do when they get up in the morning? What do they care about? What does their boss care about? All incredibly detailed. The more detailed you are about the buyer persona, the stronger you are going to be in terms of your marketing, your collateral, every element. So get that buyer persona right. Spend the time to do that, and then it won't be them in the bank. It's that guy, Joe, who's in finance and an accounting team, or it's that Tom and Jane who are in. So get that level of knowledge in your mind about who is the customer and what they care about. Get a spreadsheet ready that shows ROI for the finance guy. Get a security analysis ready for the security IT professional. All that sort of stuff. There's not sure very tactical elements there. Sorry.
So one question I wanted to ask you guys is, you're all playing in this middleware B2E space, right? And what gets a lot of attention is, these customer-facing ones, these B2C players. Stripe gets a lot of that. Square, SoFi, those sorts of players. Do you ever feel startup envy towards that type of company? I mean, you're doing really important work, and you're really enabling, and I think in the long run, these are the types of businesses that are going to succeed. But how do you feel when you're in the less sexy side of fintech?
As somebody that's tried to raise money on the B2C side and on the B2E side, I definitely feel a lot sexier on the B2E side.
If I look at 2016, I'm very glad I'm on the B2B side. What happened in 2016? You had online lenders had a few troubles, it's to say. And there was a downturn in the funding towards B2C in the fintech. There's a shift now, or the realization that B2B is a place as a VC where you can have maybe a better traction. I suppose I'm happy, really. This is a good place to be at the time being. And that will change back, I'm sure. But right now, B2B seems a good place where you can build a solid business.
I think we have to, there hasn't, for me at least, there hasn't been a ton of exciting stuff happening on the B2C side in the last couple of years in fintech, maybe with the exception of crypto. And that's probably where my startup envy lies, just because of the vast amounts of money you can raise on ICOs. But I think we've, as an industry, we've come to realize there's a lot of infrastructural stuff we have to fix before we can actually deliver the next generation of really good consumer products and services at the right price. It's like we're all working on that kind of stuff, and we just have a lot that needs to be done before we see the next wave of really cool stuff happening.
Yeah, I would agree. I think the other interesting thing about the BDE side is that it actually opens up a different set of investors. Because if you think about, your classic venture capital, they'll be very, very focused about that sexy story from the B2C side. But if you start looking at corporate venture capital, or if you start looking at strategic investors from, somebody like Goldman Sachs, they're going to be very interested in, okay, what can you do for me? What can you do in my institution itself? And so it does open up a different place to find funding. So you won't get the headlines, but you'll get the money, which is more important.
Well, let me ask about that. So, how do you? I know we're sitting in a corporate venture capital office, but how do you feel about that? Does it when you do get that money, do they help plug you into the company? Has it been a lifeline into the greater corporate? What are your thoughts on that?
So I think it is some of the interesting things for Knock Knock Labs, our most recent round of investment was led by Motorola Solutions, which opened up an entire new market for us. It opened up the first responder market. It opened up some of these emergency responders, which was not traditionally what we had looked at. And they have brought us in and walked us through many different departments in there, which has been fantastic. Another prior round of funding was led by a company called NTT Docomo, which is a mobile network operator in Japan. And they walked us through inside Docomo. And both of those opened up places that our technology can be used that our initial founding team didn't envision. They were thinking fintech, they were thinking payments. That's where they thought their brains were, and that's where their experience is. And so these corporate venture capitalists, they were able to open up new areas for our technology to be used, which I think has been very helpful.
Yeah, I mean, for us, the corporate venture capital is kind of an interesting, whether it becomes a competitive advantage or a competitive disadvantage, depending on who the venture capitalist is. So, especially with some of the bigger banks or the core processors, there's been some speculation that if you get too close to one of them, that it might distance you from the others. And so we haven't had any real deep corporate venture capital to date as a result of kind of tiptoeing those lines.
We have not raised from corporates, but if anyone wants to write a check, I'm here.
In a slightly controversial response, I'm going to say that taking money from corporates is a short-term fix, but doesn't solve a long-term problem. If you are out there looking to build a next very, very big company, you want to find financial investors who have the deep pockets and the connections that can take you from Series A to Series B to Series C, et cetera, et cetera. So corporates are great. They give you, as clearly you've had a benefit from, but you need to have a financial investor, ideally someone who is seriously connected with other VCs who they will say, oh, thank you, great you invested in that company, I want to invest you in with you next time. Once you're on that train, the VC train, you've got to be thinking about your next round and what investors, your existing investors will bring in. So I would always recommend, if a choice, always cite financial investors over corporates.
Interesting, yeah. And a follow-up question for Will. You were part of Y Combinator, I believe, right? What is their stance on corporate venture capital?
I don't know, actually.
Oh, okay.
I don't remember it being discussed at great length. They've got a number of other venture capitalists they work with. Yes. That they focus more on, and so I can't actually recall any corporate at demo day or otherwise, and that we spoke with. So I can't comment on that, unfortunately.
Okay, cool. Another question I wanted to ask was shifting a little bit to your competitors, right? So you all, I would imagine, some I know, but have incumbents that you're competing against, right? So how are you differentiating, especially when some of those how do you go into a large player and say, okay, we're different and here's why, and it's worth taking us through info security and vendor onboarding because we're going to offer a better solution. So how do you make that sell? How do you make that happen and differentiate yourself? Or do you work with the incumbents?
So I had lunch with my biggest competitor 2 weeks ago. The CEO and I were both in New York for a digital banking conference.
Who picked up the check?
I think he did, actually.
Nice.
He announced last week that he closed $21 million of funding, so I decided I'd let him buy it. For our space, it's a little unique. Most of our competition is Excel spreadsheets, so even them as our biggest competitor, I think they've got 40 financial institutions on board now, and there's 12,000 in the U.S. So, frankly, they've actually helped us significantly.
Plenty of room.
well, there's plenty of room, first of all, but when I go in and I'm trying to sell our product, it's not like I'm selling the first solution that they've heard of, but they're like, oh, there's something here. So it's actually good to have two dogs in the race. And, you can, Crossing the Chasm and some of the other books talk to this fact that if you don't actually have somebody else that's going head to head with you in the space, there's this question of whether or not the space even exists. And so having a competitor that just raised 21 million from Index and Nika is actually extremely helpful for us.
I'd 100% agree with that. The other thing is the way that the path that Knock Knock Labs took was to create an industry consortium called the FIDO Alliance. So we actually created our own competitors in many different ways. We donated some of our IP to this consortium, to this group. And part of the reason why is because we wanted to take everybody off of the old way of doing things and move everybody onto a new way of doing things, which a small startup in Silicon Valley wouldn't necessarily be able to do by themselves. And so it's kind of this frenemy, this war makes strange bedfellows sort of an aspect where we are working closely together to get everybody to be interoperable, but at the same time we'll go head to head in specific reliant party accounts. So it's both a benefit and a curse a little bit.
Add anything? Or?
I think our only true competitor is internal builds for the kind of size of institution that we target. There are sort of quasi-competitors out there. We typically work with them since that they may have a better solution for one piece of what we're offering, and we are better in another sense. And so,
do the FIs understand that you're?
It takes a little bit of education. So often there's like, well, haven't you heard of these other 5 companies? And generally the answer is we work with all of them. Or we will work with all of them if you'd like us to. If they're your existing vendors, we still have a place since our whole value prop is around bringing together multiple kinds of data, as much data as you can, to make better decisions about your customers. So we sort of welcome anyone else in the stack that makes sense. But it does take some education for some of the banks that we talk to.
Nothing to add. Thank you.
So. Just looking at what's happening in Silicon Valley right now, I mean, it seems like a correction's on the horizon, if not already started. What do you guys see for this segment in the next 2 to 5 years?
Correction in FinTech or in real estate or
I think just correction in general, not necessarily. Yeah. The ecosystem. I'm seeing it. I don't know.
So it's interesting because on one hand you have, the venture capitalists are not necessarily investing in FinTech as much, but on the other hand, you have this phenomenon of the ICOs, which are creating a massive amount of capital influx into a kind of a small segment. So to answer the question of where do we see in 2 years versus 5 years out, I think in 2 years we're going to see a lot of customization and personalization happen through deep data diving and a bunch of these aspects that FinTechs are enabling financial institutions to do. In 5 to 10 years out, I see a sea change of decentralization of a bunch of different things that is being powered by the new, I hate to use the buzz term blockchain, but there's so much power behind it that if they can figure out how to make it work, it's really going to change the ecosystem entirely.
Yeah, I think we're going to see some contraction on the consumer side, sort of like we talked about, I think with lending and other segments where VCs are a little less hot right now. I think we're probably, hopefully, at sort of the beginning of kind of the FinTech enterprise stuff where I think banks are recognizing that they don't necessarily need to compete with the FinTechs directly, but have the opportunity, like there'll probably be more M&A activity, more kind of snapping up technology companies, getting into deals that are useful to them.
I'd say it's seen some competing indicators in the market with some failed IPOs that are being widely publicized, not giving the exits to VCs that they really should be getting or wanting at least, but a really large amount of demand for Series A investments and seed investments for hot companies that are being, overly bid up and, exacerbating the same issue. So at both ends, I'm seeing some, concerns that I'm not sure how it's going to wrestle out.
I had a company went through the downturn last time, and I think the learning that I had from then was just as a general way how you do business is just be conservative, but be willing to put the gas on when it's ready. Sounds obvious, but it's often hard to time that. I think the other piece is to be ready for your OPEX story. So operational cost story, not just a CapEx, as in I can help you grow like crazy. You should also think about I can help you save money in your business, because that's how if it really does get as bad as it does get bad as last time, then everyone has to have an OPEX story.
Pitch either greed or fear.
That's a good point. I think we're out of time, right? So I don't get to ask my last question, which is how many Bitcoin do you own and should I buy? But that's it.
Save it for lunch.
Okay.
Hopefully our panel will be able to stick around with us and we can all connect with them over lunch. But thank you so much. It's been a great panel.
Thanks.
Thanks.
Thank you.